Hello, this is Ryan Ray of AAII. We are talking about the latest and greatest from the world of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we post our upcoming live show schedule on aaii.com/webinars, and AAII members do have full access to the full archive of shows. My guests today are Derek Hageman, John Bukowski, and Charles Roplet. Today's show has 3 topics. In the first segment, we winnow down the Aristocrat list of dividend-growing S&P 500 index stocks to the ones with the longest streak of dividend increases. Next, we find the mutual funds with the most consistent returns relative to their peers in the international stock categories. Finally, we explore AAII's updated rebalancing models and how you can use them to bring your portfolio back to your desired allocations. Plus, our listener mailbag segment where we answer questions submitted to us. Let's get started. Derek, last time on the show, we discussed the Dividend Aristocrats. I wanted to drill down a little bit further and ask about the first cut list of Dividend Aristocrats you wrote about in this month's AAII journal. Could you walk us through what the Dividend Aristocrats are, just as a recap, and the ones that made the first cut?
Yeah, definitely. Most of these companies, if you look at the list, they're all household names, which we will get into in a second, but the S&P 500 Dividend Aristocrats, it's really a list of high quality companies within the S&P 500 index that have not only paid dividends, but increased their dividends consecutively for 25 years. And actually, most of them have done so for 40 years or more. Let's see, they also must meet certain market capitalization and liquidity requirements. So investors in the Dividend Aristocrats, they're investors that are seeking dividend sustainability. I'll just get into a few of the other specifics, but constituents must also have a float adjusted market cap of at least $3 billion and an average daily value traded of at least $5 million for the prior 3 months. And right now, there are currently 65 companies that meet the designation requirements. And just to give a little context, a little history, the Dividend Aristocrats list, it started in 1989. And when it started, it only had 26 companies meeting the designation requirements. And the list has fluctuated a bit over the years. But like I said, there are currently 65 companies that meet the current requirements today. And one of the exchange traded funds or ETFs that invests in the stocks of the Dividend Aristocrats is the ProShares S&P 500 Dividend Aristocrats. The ticker is NOBL or Noble. And actually, for a complete list of the Dividend Aristocrat companies, viewers can go to the ProShares web link, and we can put that web link on the screen. So in terms of the first cut article, we actually started with companies that make up the ProShares S&P 500 Dividend Aristocrats list, and then we researched each Dividend Aristocrat stock to determine how many consecutive years it has increased its dividend. And the first cut list in the AAII journal, we're showing the top 20 Dividend Aristocrat stocks with the longest streak of dividend increases. And all of the companies on the list, they've increased their dividends for at least 48 consecutive years. And some of these companies, they include 3M, Johnson & Johnson, Coca-Cola, Colgate-Palmolive, and Target. So definitely household names. And actually the top 4 companies on the first cut list with the longest streak of dividend increases is a company called Dover Corp. Dover manufactures a broad range of specialized industrial products and sophisticated manufacturing equipment. There's also Emerson Electronic, Genuine Parts Company, which is a leading wholesale distributor of automotive replacement parts. And then to round out the top 4 is Procter & Gamble. And of course, they have all their iconic brands such as Pampers for diapers, Tide laundry detergent, Charmin toilet paper, Gillette razor and skincare. The list goes on and on. There's also Crest toothpaste and Pepto-Bismol if you have an upset stomach. So all four of those companies in the top four of the first cut list, they have dividend increase streaks of 64 years.
These 20 stocks have consistently increased their dividends for many consecutive years, as you mentioned. How do these companies stay so reliable in terms of dividends? Is there a common characteristic, perhaps, among these stocks?
That's a good question, and you're definitely right. The Dividend Aristocrats, they're all high-quality dividend-paying companies. They've all continuously grown their dividends. And how do these companies stay so reliable in terms of dividends? And you asked, is there a common characteristic among these stocks? Well, there are actually several shared characteristics among these companies. First, in general, like I said, they are all high quality companies that have a long history of being a leader in their sector and industry. Next, I would say they have typically displayed durable business models, stable earnings, solid fundamentals, strong histories of profit and growth. And they have exhibited, I would say, solid performance characteristics over a wide range of market conditions. They tend to also have strong brands. Most of the companies are global companies, not all of them, but most of them. They have strong balance sheets. I think that's a common characteristic. And they typically are the number one or two player in their respective markets. So they have some important competitive advantages. And in many cases, there are high barriers to entry against the Dividend Aristocrats. And lastly, I'll just also add that these companies, they realize that many of the investors in their company are income-oriented investors, and they understand the importance of dividends to these investors.
Derek, I want to quote from your article. You wrote that, quote, the Dividend Aristocrat strategy has demonstrated a history of weathering market turbulence over time by capturing most of the gains of rising markets and fewer of the losses in falling markets, end quote. Not sure if you're aware, but we've lived in a pretty turbulent time during the pandemic. How has this unique market situation challenged the philosophy of the Dividend Aristocrats, if at all?
Yeah, I mean, Ryan, can you believe it's been a year? And what you said is definitely true. It has been a pretty turbulent time. But one thing I can say about the Dividend Aristocrats philosophy is despite challenging economic times, there are certain companies like the Dividend Aristocrats that have grown their dividends during previous downturns. And there may be a precedent of their willingness and ability to grow dividends again. And while much remains uncertain, the highest quality companies, and I can't stress that enough about the high quality companies that are part of the Dividend Aristocrats, they have, however, proven their ability to grow their dividends over time. I mean, they've demonstrated an ability to survive through a range of market environments, even raising dividends after previous recessions. And they prioritize sustaining dividends in challenging times. I would say that's one of the main pillars of the Dividend Aristocrats philosophy, is that in challenging times, they have prioritized sustaining dividends, and they really are dividend paying royalty. I think, I just add that I think this unique market situation, it has actually supported the Dividend Aristocrats philosophy. In this volatile market, protecting current income for investors, it's more important than ever. And there's a lot of focus on balance sheet health and adequacy of cash reserves, including dividend safety. And I think this market has actually strengthened the desire for income investors to invest in the strongest companies with fortress-like balance sheets and ample cash balances. And that's exactly what the Dividend Aristocrats delivers.
All right, so this first cut list is a jumping off point for stock ideas, but if you're a dividend-oriented investor, the cream of the aristocratic crop seems like a highly desirable list. If people were to, say, create a portfolio of these 20 stocks, would that be a shortcut to success with these dividend payers? Do you have any perhaps cautions for people who might be seeking to do this with this specific list?
This is a good question. And I mean, in short, I would say it is a good place to start for the reasons we've already discussed. I mean, these companies, they're all household names. If you look around your kitchen, your bathroom, you'll actually see a lot of the products that that these companies sell, manufacture, produce. And for dividend investors seeking dividend safety, I mean, investors could definitely do much worse. But however, there are a few notes of caution. Recall that to be a part of the Dividend Aristocrats stocks, they need to be a member of the S&P 500 index, and they need to have grown their dividends for at least 25 years. And that produces a certain result. In general, these are all large cap stocks, but there are no other requirements to be a part of the Dividend Aristocrats. I mean, there's no minimum yield threshold or dividend growth rate. There's no valuation metrics that are considered. So yes, they have proven their ability to sustain rising dividend payments for decades, but this track record, it's only based on a few criteria. And some of these companies, they have dividend yields that are considerably below sector or market averages. And there are alternative dividend investing strategies that might offer superior income investing opportunities. And these strategies, if you look at them, they do require companies to have raised their dividends for a significant period of time. Many of these strategies require 5 or 7 years of consecutive dividend increases. Additionally, I'd like to mention there's no dividend growth increase requirement that the companies must meet to remain on the list. Therefore, a company that hikes its dividend by a mere fraction of a cent, it can remain on the Dividend Aristocrats list.
So in other words, they might be showers, but not dividend growers.
Exactly. That's a good way to say it. I mean, there are a couple companies that have raised their dividend a penny from one year to the next. And yes, that qualifies. That means they have technically increased their dividend, but there are other dividend paying stocks with higher dividend growth rates. And then one other thing I would just call out is that the Dividend Aristocrats, they do not consider any valuation metrics to be on the list. And the company's share price, it could be in a free fall, and that would not affect the company's aristocrat status in the least. And one thing I just want to add to dividend valuations, I mean, stock prices, they tend to fluctuate between high and low extreme valuation levels. And these relationships can be used to determine a stock's value range. So to help determine a stock's valuation, some alternative dividend investing strategies, they will compare a stock's dividend yield, its current dividend yield, to its historical average yield and market yield. So lastly, it's helpful to understand the difference between the Dividend Aristocrat strategy and other dividend-focused strategies by examining the portfolio holdings by S&P 500 sector weightings. So for example, the Dividend Aristocrat strategy, it's more concentrated in basic materials, industrials, and consumer defensive sectors compared to the S&P 500 index, and it's underweight communication services, and it's really underweight technology sector stocks. So really, to wrap it up, I mean, there are some key advantages that we discussed for income investors considering the Dividend Aristocrat strategy, but there are other strategies that may better satisfy investors' need for current income and capital growth.
All right, well, I want to thank you for your time, Derek. If you'd like to learn more about the Dividend Aristocrat First Cut list, I'd recommend you check out Derek's article in the March 2021 AAII journal titled Dividend Aristocrats with Longest Streak of Dividend Increases. That's, of course, available in the print edition of the journal and on AAII.com. Thanks, Derek.
Thanks, Ryan.
John, you have produced mutual fund and ETF risk cuts in this month's AAII journal. When we talk about international funds, are there considerations for investors that are different than domestic ones? I've noticed there are a few funds on this list from China, Europe, Japan, Latin America, among other regions.
Yeah, well, it's a very important question. In fact, I'm going to throw a question back at you, Ryan. When it comes to the global stock market, what percent of the overall world stock market do you think U.S. stocks represent?
I think I'm going to guess around 22%.
It's actually 40%.
Oh, wow.
So the U.S. represents 40% of the overall stock market. So if you are only investing domestically, and there's always a tendency for investors to really push their domestic holdings higher, you're ignoring 60% of the overall world stock market. So really, it's important then to, the question is, why would one have some international stock exposure? Because if you don't, you're kind of excluding a good part of what's happening in the world. And it could be different characteristics as far as diversification and whatnot. The challenge, though, when it comes to international investing in international stocks is there's really two kinds of considerations or risks. One is the actual holdings themselves. If you're buying these stocks, these companies, they're going to have their own potential of growing or not growing or having financial issues or whatnot. So there's the overall return of how that particular company is doing relative to its internal country's economy and overall global economy. But then separately, because you are buying stocks that are going to be held in a different currency, you're exposing yourself to currency risk. So you hopefully, when you're buying these foreign stocks, you want the dollar to be very high, and when it comes time to redeem these foreign holdings, you want your dollar to be weak. So there are considerations that come into play, and therefore there are times where these foreign stocks do, perhaps better than the U.S. market, but because of currency concerns, they might perform differently. Now, long term, the currency risks kind of wash themselves out, but it is something to keep in mind as far as the overall performance. The other part, I guess, is it all comes down to strategy. You have to kind of in advance decide, do I want international stock exposure? How much of that should there be as part of my overall portfolio? And how can I achieve that? So really, it's easy enough for an American investor to buy U.S. stocks and to get their exposure to U.S. stocks by buying individual securities, individual companies. I could put together a diversified portfolio pretty easily. If I want exposure in certain countries, it's very difficult for me to buy those stocks directly. So I have to, in effect, use mutual funds. And that's why really, whether it's mutual funds or ETFs, that's why you want to take a look at those types of instruments. And because of that, it's your only ability to get international exposure is through these international funds and ETFs. And then you have to make sure it's meaningful enough in your portfolio. So you want to make sure at least 5% of your portfolio, less than 5% of your portfolio is devoted to these stocks. There's no point in actually adding it. So in that context, the concerns are similar to buying US funds, but really it starts off with your overall global plan.
Your first cut lists are about how we find the mutual funds with the most consistent returns relative to their peers in the international stock categories. How did you come about making and filtering this list?
Well, again, the peer comparison is critical because, you've been mentioned before, I think that there's a big dispersion in the rates of return. So, a fund, looking at, and as a member of the association, if you go to the funds idea section, the mutual funds part of the website, you'll have a table of performance of these different categories of funds and index funds over time. So, when it comes to that kind of performance, you want to make sure that, for example, Latin American funds have suffered recently, and funds that are in Japan or Asia have done reasonably well. So if I just screen for funds that have high rate of return, I'm going to have certain country exposure that I may or may not want. So when you do these kind of comparisons, it's very important to compare a fund's performance against funds in the same category. So you want to decide as an investor, do I want to make it simple? Do I want to simply pick a diversified international fund and then invest in all the countries, developed or emerging? Or do I want to go ahead and make some sector or in this context, country bets? So in that case, I want to compare how the different Japan-focused funds have done or how the different European funds have done. So I want to compare the performance of European funds against European funds, diversified funds against diversified funds, and understand that you're comparing performance within that category. And I always prefer to look at consistent performance over just simply most recent performance. I know it's exciting to look at 1-year rates of return, but you're really hoping for funds that have been able to outperform their peers for a consistent number of years, 3 years, 5 years, 10 years, and they're doing so by keeping costs at play. And that's why we go beyond just looking at performance. So we constructed these first cuts. We looked at performance, of course, relative to peers, looked at how well they kept their expenses in check. Now and again, expenses you want to compare against other funds in the same category. If you look at the expense ratio for the typical European fund, I think it comes in at maybe 1.3 or so percent versus a domestic large cap blend fund, which is in the 0.9% range. So if you do a comparison of expenses, you want to compare international funds have higher expense ratios than domestic funds as a rule of thumb. So compare your expenses against funds in the same kind of category. Now, I didn't do anything on risk, and that's up to you as far as deciding how much of a risk profile you want. But we did focus in on no load funds. And in the journal article itself, we specifically looked at funds that were open to new investors. But of course, if you have a fund that you're happy with, you'll compare it against these funds and see how its numbers compare. So in that case, if it's closed to investors, it may still be a good investment to stay in.
You mentioned consistent performance. One of the reasons that these first lists come together is consistent outperformance. I'm wondering a little bit about that against the context of the global pandemic. Do you expect the market turbulence we've experienced to impact these international funds?
Well, they certainly have, and they've impacted them in many ways. We talked about the currency risk as an example, and if you look at the performance numbers, the Asian-based funds have done very well in the last few years. They've outperformed the U.S. and even and in that context, even international funds in Europe have underperformed the U.S. So there's companies that are in different stages of their economic growth and have been hurt and impacted at different stages as far as their ability to come back from the impact of the coronavirus pandemic. We've seen that China hasn't missed a beat. The U.S. is coming back strong. Europe is still struggling. The UK has had things under control, but Europe itself is still struggling as far as these things. So they're in different cycles of development, and Latin America has suffered as well. So the one thing of looking at international funds and why people have them is that they have the potential to have good, strong rates of return as the U.S. market, but they will typically perform a little bit differently, and that's called diversification. So it's the ability to, in effect, keep your overall portfolio's rate of return high, but perhaps reduce some of the volatility. So now diversification is a two-sided coin. Because of that, you're going to have some years where your rate of return will be a little bit lower, but you're not going to have the big upward spikes and downward spikes as well.
As has been described, the first cut list is a jumping off point for stock ideas. Let's say you're a fund curious or fund oriented investor. Would you think that a portfolio of these 20 funds that you've made a list of would that be well balanced, or other than what you've outlined here, are there some things one might want to think about with this specific fund list?
Well, the key thing here, I guess, is whether or not what funds are available to you in your situation. Unlike a stock portfolio where you're buying many stocks, with a fund portfolio, you should only need, if you want to have a diversified international equity fund, you only need one. But now the question is, where are you buying that fund? If you're buying it through your 401k plan, you may have one fund to choose from. So in that case, compare that fund offering against this list and see if the rates of return within their category are similar. So really, it's a good jumping off point. But again, your situation, as far as if you have a tie to a specific fund family or a specific broker, may contribute as far as what kind of funds are available to you. Now, as a A+ investor subscriber, you could use our mutual fund screening tool, and you could specify a fund family if you want to, and then do comparisons against a fund family or two and see how the options are available to you.
Yeah, as is everywhere, diversification is important, and you should always compare what you're being offered versus what you currently have. Correct?
Correct, very much so. And again, try to keep expenses in bay. Look at the risk profile, because one way to obviously one way to get higher rates of return, what looks to be higher rates of return, is to have higher risk or higher volatility. And there's always, when it comes to investors, there's perhaps two things that kind of drive us crazy, I guess, as investors. One is, how do we stay focused and not panic when the market's going down? So we don't want to pull the trigger at the wrong time. And the other one is, how are we doing relative to our neighbors? Because if I'm invested, if I bought emerging market funds and it's based in Latin America right now, I'm questioning, is that a good decision? Well, you can't just look at past performance. I guess your question is, how will things go in the future? So one of the things about this, so any kind of investing strategy is, can you live through a solid strategy when perhaps your segment's underperforming and not make, jump the gun at the wrong time?
Well, thank you for that, John. That was very informative. If you'd like to learn more about the International Stock Mutual Fund First Cut List, I would recommend that you check out John's article in the March 2021 AAII Journal titled International Stock Mutual Funds Outperforming Their Peers. That's available both in the print edition and on AAII.com. Thank you.
It's a pleasure. Thank you.
Charles, for the viewers at home, could you explain what rebalancing is and why you've been running a long-term analysis of it?
Sure, absolutely. So rebalancing is simply the practice of taking your portfolio and bringing it back to your target allocation. So if you start off with a set allocation and you do nothing to your portfolio, over time, your mix of assets and even your mix of asset class groups is going to drift, because different assets and different asset classes are going to have different returns. So to give people a really simplistic example, save a portfolio that's 60% stocks, 40% bonds, and you do nothing to the portfolio. Over time, your portfolio will evolve, and since stocks tend to outperform bonds, you may wake up one day and suddenly find your 60-40 portfolio is now 70% stocks and 30% bonds. Well, that's not your targeted allocation. So with rebalancing, you're simply taking your allocation and bringing it back to target. So in this case, you would sell some stocks to lower your stock allocation down to 60%, and you would buy some bonds to bring your bond allocation from 30% up to 40%. So the whole idea of rebalancing is really the concept that if you think allocation is important and you have a certain allocation you desire, and it doesn't have to be 60-40 stocks. And in fact, it doesn't just have to be stocks and bonds. It can be stocks, bonds, and cash. Maybe you like commodities, maybe you like real estate, whatever that mix is. The idea is if you have a set percentage of what should be allocated to each asset class and each asset class group, over time, you're making small adjustments to your portfolio to bring it back to that target allocation.
So we're thinking about this because you recently wrote an article in the AAII Journal about rebalancing. What would you say to those who look at the article but use an allocation that's different from AAII's moderate portfolio, which is used in your models?
I think the big lesson is to really look at the big numbers and look at it from a high level. I had to use one allocation so things would be consistent. But when you start looking at some of the numbers and what the effects are, you start seeing trends that really apply to a variety of allocations. For instance, if you don't do anything, which we call it the non-rebalanced portfolio, and I've been running the numbers going back to 1988, so we have a long history, you see when you don't rebalance, all of a sudden your portfolio shifts. And because stocks are the best performing asset, you start noticing the non-rebalanced portfolio, where it's just been a pure buy and hold, suddenly is really a high level of stocks and much higher than that starting allocation, in this case, which was our moderate portfolio allocation. So you start seeing this, what you really notice is over time, the portfolio drifts from its allocation. But the other key lesson is to really pay attention to risk. Because you're not changing your portfolio, if you don't do anything over time, your level of portfolio volatility, how much the portfolio how much the portfolio changes over time, you start seeing that rise. So you start seeing higher volatility, more fluctuations. And so I think the big lesson is what people should get from it. If I don't do anything, I'm going to end up with a portfolio allocation that's a lot different than what I started with. It's going to have a lot higher risk. But if I periodically rebalance, I'm going to see the risk is reduced, and I actually get a really good trade-off for risk and return. So again, it's not that singular allocation model I'm doing, but really the lessons and what happens when you do rebalance and what happens when you don't rebalance, and how those two portfolios, how the outcomes really have a huge contrast with each other over time. And that's really the big lesson, is you're trying to actually preserve your allocation, because if you don't rebalance, you're going to lose your starting allocation. And if that's the case, then you have to ask yourself, was it the right allocation to begin with? Or should I have, along the way, been making small adjustments to make sure I preserve that allocation?
So many of the association's members are retired, and indeed some investors are retired as well. How does rebalancing affect withdrawal strategies in general?
Well, it's interesting. So we have two portfolio models I use for rebalancing. One is we rebalance periodically. The other, we never rebalanced. And what we saw in the portfolios that we never rebalanced is that we start taking withdrawals. Over time, it starts failing, meaning that certain asset groups, certain asset class groups start running out of money, such as emerging markets. Now, in a real world situation, for our models, we're taking equal amounts of withdrawals out of each fund. We use funds to represent different asset classes. So each year we're taking the withdrawal amount and we're splitting it equally among each fund. So over time, some of those funds are actually running out of money. You've withdrawn everything invested in that fund. In a real world position, you would actually probably make small adjustments. You might determine, you might take out more of fund X instead of fund Y. Well, when you're doing that, you're essentially still doing a form of rebalancing. So the big lesson to learn is that with rebalancing, you're actually preserving your allocation, you're preserving your portfolio. And if you're taking withdrawals and you're not rebalancing, then realize at some point along the way, you're going to have to make some adjustments to either maintain that exposure to certain asset classes or make the conscious choice that, hey, I don't need to be invested in this asset class anymore. I'll just let it go.
Speaking of the real world, since rebalancing can result in capital gains, what suggestions would you give to those who are concerned about the tax impact of rebalancing?
Well, there's a few things that people can do, and I actually reference a Vanguard study in the article, but one of the things that they can do is simply rebalance less often. So I used the example earlier of a 60-40 portfolio. A traditional 60-40 portfolio is 60% large cap stocks and 40% bonds. That portfolio is rebalanced annually. So if you rebalance annually, it means each year you're going to have a taxable event. For our models we test, we actually use a 5% band. So again, just sticking with this very simple allocation because it's easy to understand. In our case, we're using a 5 percentage point band. So if the stock allocation say goes above 65% or goes below 55%, meaning 5% above 60% or 5% below 50%, we're going to rebalance the portfolio. Now we use asset class groups, we use international stocks, we use mid-cap stocks, so the rebalancing triggers are a little different, but that's the general idea. So you could use a wider band, say 5 percentage points, or if you really want to avoid taxes, maybe you look at a 10 percentage point band, which means you're letting your allocations swing as much as 10 percentage points off target. And you certainly can use another version than that, but the idea is you have just essentially wider bands, so longer periods before rebalancing is triggered. And that'll minimize the number of taxable events you have. You could also use your tax preferred accounts. Say you have a 401k, you have an IRA, you have a Roth IRA. So you could use those to do your rebalancing because account transactions in those accounts are not taxed. If you realize a gain in your IRA or your Roth IRA, it doesn't generate any capital gains taxes. If you do it in your traditional brokerage accounts, which is taxable, then you'll incur capital gains taxes. Another alternative is that you just do partial rebalancing. So say you're too heavy in stocks, or maybe you're too heavy in bonds. Well, maybe you withdraw a little bit out of it this year with a plan to maybe do a little bit more rebalancing next year. So you might have more taxable events, but they're smaller. And that can particularly be a strategy that's good for people who are concerned, say, about Medicare premiums or Social Security taxes, where they're trying to limit the tax impact in 1 year. So any of those will work. And certainly look at your other deductions. Do you have medical deductions? Are you making a big gift to charity? Those type of things can be used to offset capital gains taxes in general, or at least overall lower your tax bill.
Thanks, Charles. If you're interested in reading more about this, you can check out the article titled Rebalancing Update, a revised allocation plus additional insights in the March 2021 issue of the AAII Journal, both in the print and at aaii.com/journal. And now for our listener mailbag segment, where we address questions that have been submitted by viewers and AAII members and answer them here. If you have a question for us, you can submit them using the question panel in your GoToWebinar control panel, or you can email me rreeh@aaii.com with the subject line II show question. All right, Charles, these questions came in and I wanted to have you answer them. This one comes in from George B. He says, my investment rep gave notice of a, quote, modified Dutch auction. The statement was not totally clear to me. Do I have to participate in this auction? Per their offer of $40 to $45 per share, if I'm understanding how it works, I would take a loss versus the current market price per share of their stock. Is it best to just call the company? If so, do I call investor relations? Define what a modified Dutch auction is.
Sure, that's an interesting question because we are seeing the IPO market heat back up and some companies are choosing to use Dutch auctions. So to understand what it is, let's back up a little bit. So in a traditional IRA, company hires investment banks and those investment banks then pull institutional investors. They kind of gauge support and they decide what's the stock going to be priced at for the IPO. So maybe they decide, looking at demand, they're going to price it at $20, they're going to price it at $25. In an ideal world, the investment banks will price the IPO at the highest possible level they think they can sell all the shares. Maybe it's 5 million, maybe it's 10 million shares, but they're actually setting the price that the IPO takes place at. Which with a Dutch auction is actually the opposite versus an investment bank setting the price. Potential investors are pulled and they're basically asked to place a bid. How much would you pay for the stock? So instead of investors saying, okay, I want to participate in this IPO, the price is $25, I'm willing to get X number of shares. Instead, investors are saying, I'm looking at this IPO, you know what, the most I'll pay for it is maybe $18, maybe it's $15. But in some cases, maybe the investors will look at that and say, you know what, I really think this is a good company, so I'm willing to bid, say, $40. So in a traditional Dutch auction, they're actually looking at what is the highest bid, what's the highest price somebody's willing to pay for the shares, and that determines the IPO price or the offering price. In a modified Dutch auction, the rules are a little different. What commonly happens, and I'm not saying it happens in every case, but what commonly happens is the underwriters will look at all the offerings being made and they try to see what is that point at which you see both the highest price, but also the largest number of people bidding for that price. So maybe you have a small number of investors who are saying, you know what, I'll pay $40 for that stock, but at $35, you see a much larger pool of investors saying, I'm willing to pay up to $35. So the company may not be able to sell the shares at $40, but because they're going down a little bit, they have this huge pool of people who are saying, you know what, as long as it's no more than 35, I'll participate. So therefore, they're able to actually get more participation in the IPO and get more shares sold. So that's kind of how a modified Dutch auction represents. Now, it's typically used for IPOs, but it certainly can be used for other offerings as well. For people who have questions about the specifics of the Dutch auction, they can't get an answer from their broker, I would suggest trying to contact the investor relations department of the company you're interested in and asking for the details. Now, keep in mind, regardless if we're talking about an IPO or a secondary offering where a company's offering shares, you as a shareholder are under no obligation to participate. It's always your choice as to whether or not you want to participate. Now, if it's a secondary offering and the company's making it available to existing shareholders, realize if you don't participate, there might be a chance your shares are diluted, particularly if these are new share issuances. So you may say you might be comfortable in having your shares diluted, your ownership diluted, and that's fine. It's always your choice. You're never required to participate.
All right, this question comes in from Monk M, and this question is regarding risk. And on the last show, when you talked about assessing your risk tolerance through the individual investor wealth building process. All right, the question is, how do I translate where I am in the risk table into an actionable strategy? This is nice, but I want to know how to make this actionable.
Sure, that's a great question. So our wealth building process toolkit, which is available on the Learn and Plan tab of AAII.com, gives you a framework for creating a comprehensive investing plan. So within that toolbox, you'll actually find a series of challenges and a series of worksheets you can actually work through. So to get to Monk's specific question about how do I take risk tolerance and apply it to my investment strategy, your next step would actually be to define an allocation or to pick an allocation. So depending on what your risk tolerance is, you want to pick an allocation that's appropriate for your level of risk. So if you describe yourself as, say, being very aggressive, you want an allocation that's mostly equities because you have the financial and psychological tolerance, and also the to really maximize your growth. However, if you say, you know what, I'm conservative, I have short time horizons, I don't tolerate volatility as well, then maybe you want to opt for a more conservative allocation. So that's really the next step. It's really in a wealth building process. It's identifying your goals, then define your risk. And once you do those two things, pick your allocation, because once you have your allocation picked, then investing is really a process of filling in the holes. Okay, here's the general allocation I'm trying to fill. Now let me figure out what stocks or what bonds or what other assets I should pick to fill those allocation portfolios. So that's the process.
All right, I want to thank our viewers for those questions. Again, if you have a question for us, you can submit them using the questions panel in your GoToWebinar control panel, or you can email me rreeh@aaii.com with the subject line II show question. Of course, we'll get them on air for the next II show for Charles to answer. Thanks, Charles.
Thank you, Ryan.
If you liked our show, please visit aaii.com/webinars to register for more great webinar and video content. Like us on Facebook and follow us on Twitter @AAII_invest_ED. For more investing education, I invite you to check out our website, aaii.com. Again, I want to thank our guests, Derek Hageman, John Bukowski, and Charles Roblett, and you for listening. We'll see you next time.